Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Advanced Charting Techniques. And today we're talking about a technical indicator that was first introduced to the markets back in 1976. And is it possibly the ultimate oscillator? Yeah, as a matter of fact, it is. It's called the ultimate oscillator. That's what we're going to be talking about. We'll talk about how it's constructed and how it might be used to generate trade signals. And we're going to be going through example charts. We're actually going to be placing an example trade, time permitting. So looking really forward to this. Before we can get to that, though, let me first say hello to everybody that's already chatting out there in YouTube. Great to see SJS Photography and Robert, Grace, CKC, David, Ricebird, everybody else. Thanks for joining us week after week. Also want to welcome anybody that might be new here. It's great to have you on board. And if you're watching the YouTube archive after the fact, enjoy the presentation. But be aware that you're invited to join us in a live discussion. If you'd like to be here, kicks off promptly 1 o'clock Eastern time on Fridays. So we'd love to have you. And as another heads up, my very good friend Connie Hill's hanging out in the chats in the live stream with us. She's going to be addressing any questions that I can't get to during the flow of the presentation. Thanks for being there for me, Connie. And also, Connie and I would like to issue an invitation to you to follow us on X. If you're not doing that, it's a great resource you may not be taking advantage of. The best place to connect with your favorite presenters. But you can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. All right, but let's get to it. This discussion of this indicator, long-time indicator, known as the ultimate oscillator. But before we can get into it, of course, we have to pause to consider the risks associated with trading. Risks are real. Bear this important information in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay? So, setting the agenda for today, we're going to be talking about the ultimate oscillator. So you know me, if you've watched on my webcast before, the first thing I like to talk about is how is this thing constructed? That, I think, can provide some insight into the motivations for why a trader might choose to use it or not in their technical analysis of stock charts and the planning of stock trades. So we'll talk about how it's built. Then we'll talk about how the ultimate oscillator is used to generate trade signals. And we're going to talk about it for uptrends, downtrends, sideways trends. So yes, it's typically used in combination with a trader's outlook on a stock already. And then we're just going to apply that across a few stock charts so that we get familiar with the usage and we start to visualize exactly how it might be implemented, okay? Now, of course, never take this as a promotion of a specific approach to trading. This is always just a discussion we're adding to our potential toolbox of technical tools that are available on the Thinkorswim desktop platform. So let's go to it. Let's go to Thinkorswim, and to kick things off, I wanted to go back to a stock that we were just talking about in a previous webcast, and just apply this indicator. Look at the same stock, but through a different technical lens. And as we do this, do me this favor, chat in. I like to know this. Chat in, let me know, are you familiar with the ultimate oscillator, yes or no? Because this is one, it's buried down the list in alphabetical order. Unless we go all the way to the bottom and do a little bit of searching, it's an easy one to miss. So while you're chatting that in, I'm going to go to our Edit Studies icon. We could just scroll right to the bottom and then up a little bit, and there's our ultimate oscillator. Or we could type in ultimate right up here and do a keyword search. That would narrow the field of potential studies down. And this is exactly what I suspected. The chats are coming in already. And here's what I'm seeing. Universally, nope, never heard of it, right? No. Okay, yeah. So, Shiva says they've heard of it but never used it. Yeah, okay. So we do need to go at a pace, even though this is called advanced charting techniques. I would consider this to be in more of the advanced category of technical indicators. But we still need to make sure that everybody can follow along with the logic and the potential application of the indicator. So let's add this to our chart. As always, we can see we can get a glimpse of the internal workings of the indicator by looking at these numbers here, 7, 14, and 28. Okay, I'll talk about those as we build the indicator, but let's click apply, not build it, but apply it. Apply and click OK. And already we have an indicator. It's down here as a lower study, just oscillating back and forth as a green line. It looks very much like so many of our other oscillators, stochastic, RSI, CCI, and the rest. And but the range is a little bit different for this one. Okay, the range actually goes from 0 to 1. 0 is the lowest it can go, almost never goes there. 1 is the highest it can go, almost never goes that high. As a matter of fact, I don't know that I've ever actually seen a 0 or a 1 accomplished here. This does typically have, in this case, most commonly, we're only looking for an oversold level on this oscillator. Okay, so we'll talk about that. Dragon Rider, did you hear about this from my class that you've been watching for a while? Because I don't think I've talked about the ultimate oscillator in a couple of years. I think. I'd have to go back and look, but I'm not sure. Anyway, so let's get into the construction of this. Yeah, there are a few steps to this, okay? This was introduced by a trader named Larry Williams, a technical trader who's actually created a number of technical indicators that are still in usage on stock charts today. Introduced by Larry back in 1976. And what he was looking for is basically across 3 time frames, 7 trading periods. We're looking at daily charts. So we're going to be talking in those terms. But he looks back over 7 days, 14 days, and 28 days, represent a week and a half of trading, half a month of trading, and then a little bit more than a month of trading. But in any case, over that time frame, what he wanted to know is, as prices have been moving down, up and down throughout the day, have they generally been closing closer to their highs or more distant from their highs? And he wanted, he actually built this oscillator around that concept. Because if a stock has been moving, if it's been consistently over several time frames, closing very close normally to the highs, maybe that stock is starting to get overextended. On the other hand, if the stock has been closing more distantly from those highs, so we're kind of getting long wicks on a typical candle, maybe that's been pushing the stock lower, and especially if it's been sustained over a period of weeks and into a month, maybe we're hitting lows. Maybe the stock might be hitting extremes on the stock chart. So here's exactly how this is built, okay? It starts with something that Larry calls buying pressure. And buying pressure, according to his definition, pretty straightforward. He just takes the closing price of a given candle. We're looking at daily candles again, so it's the closing price of the day. And he subtracts from that the low of the day, or the close of the previous day, if that happened to be lower than that day's low. Okay? So if you can envision this, and maybe we can zoom in and just pick a candle here. Let's pick a candle or two here. I don't know, just pick a random candle right there. This one will serve our purposes. So here's our candle back on August 14th. Our close was up here at the top of the body. It's a white candle. We closed well above the low of that day. So conceptually for Larry, that means that during that day we had some buying pressure pushing us up closer to the high than the low. Had we closed closer to the low, we would say that there was very weak buying pressure. Now, he also includes, rather than just looking at the close versus the low, he'll look back at the prior, let's put this in here too, the prior or the previous close. So he'd look at this, at the close from yesterday, and he would include any upside gap in this discussion. So in this case, our close from yesterday was actually higher than today's low, so he would use today's low in the calculation. So it's either the low or the prior close, whichever is lower, showing us how much buying pressure we're getting pushing toward today's close. That's the concept, okay? Now, the second step in calculating this oscillator is to calculate something called the true range. And instead of, and this one's actually pretty simple, we're going to take the original calculation here, copy that, paste it right down here, and then we replace this with an equal sign. There we go. But the true range is calculated, instead of using the close, it uses the high. And if both of these are very similar, like in this case, you'll notice the close was not very far away from the high. If that happens once, that's, maybe an anomaly. If that's happening over 7 days, over 14 days, over 28 days, and it's doing that consistently, that might be a strong indication of heavy buying pressure. Does that make sense? Closing very close to the range of price, but basically the high, to calculate the true range, we take the high and subtract the low, or take the high and subtract the day's previous close, whichever is lower. So that determines the range, and then we're seeing how high we finish within that range with our buying pressure. That's the concept. Number 3, we take an average of that. So having this again happening on a single day, not terribly interesting. If it happens consistently over a number of time frames, then to Larry Williams, this might add up to something that's more significant. But to determine our average, we just take the total buying pressure for a given time frame, and we divide that by the total true range for a given time frame. Now, as I mentioned, Larry does this over 3 time frames. And we saw these as we opened up that indicator. It's 7 days, 14 days, and 28 days. And now this is where we're going to get a little bit heavier. I'm just going to throw in the equation here. You can apply it if you like. You can go back and watch the archive and sort of think through it. If you're that sort of person who really likes to know the inner workings of an indicator. If it's an advanced webcast, I think we can afford to get a little bit advanced and understand the algorithms here. So what's the algorithm for this? Well, we ultimately want to generate a weighted ultimate oscillator value. And that actually is the line that we're talking about. And that line is generated by taking the average of 7 days, and we weight that heavily. So what Larry's doing here is he's giving more importance to the most recent 7 days and where they closed within their true range versus what happened over the last 14 days, and the last 28 days actually gets the lowest weighting. So we take the average of the last 7 days, multiply that by 4 to give it a strong weighting. We take the average of the last 14 days and multiply that by 2 to weight it, but not as strongly. And then finally, we just add the average of 28 without assigning any additional weight to that. And then we just total them all up, divide them by the total number of weighted values. Okay, 4 plus 2 plus 1. And then finally, to give it a value between 0 and 1, we multiply the result by 100. That's the equation, okay? But basically, we're looking at how close are we closing within the average range over the last since the open, or since the low, or since yesterday's close. How close are we getting? How often is that happening in a 7-day period, 14-day period, a 28-day period? We're giving the greatest emphasis to 7, and that generates for Larry and for traders who use this approach, this line. Okay, that's the calculation. I'm just going to hide that now, and let's get our focus back to how do we trade it. But ultimately, what we wind up with is this oscillating line. When we're way up here, that can indicate that we've closed very close to trading highs within our range. If we're way down here, we've sustained closes closer to those lows within our range. SJS photography, is that cool? You don't like long top wicks? Yes, and so for some traders, they'll actually use this indicator, apply it to what they're already suspecting is going on with their chart. So let's say we have a trader who has analyzed what's happening with the chart. Maybe they've identified that we're within an apparent uptrend, but they're looking for periods where those average values over time have reached quote unquote extreme lows. So how is that defined? Well, as with so many other oscillators, the trader will typically look for an oversold condition. Now this one, unlike other oscillators, you know, sometimes our oversold is below 20, sometimes it's below 30. Typically with the ultimate oscillator, that value can fluctuate depending on one's trend identification. So typically within an upward trend, the oversold down here is seen as any value anytime we see this oscillator dip down below 40. So you can see we've been sustaining an upward trend here for a while. So I'm going to draw in a line here. It's not applied automatically because it's so flexible. But let's draw in a line at about 40. That's about right there. There's actually, if you're looking really closely, there's a little dashed grid behind the indicator. And you can dial up the thickness of that grid. However, it's not always right at the 40, so it's not really worth it to do that. Instead, just using the numbers. Most traders won't even have the bother to draw in a line like this. They'll just look at the numbers for the indicator. But here's how we might generate a trade signal on an upward trending stock. The first step is to identify that trend. So in this case, looks like we've been trading within a channel. And then we look for our oscillator to work its way down below 40, and that might have that trader on high alert. Ooh, this might be about to signal, well, we're hitting short-term extremes as defined by this oscillator, and the signal comes when we slip back up above 40. So remember, maybe be in the habit, if we're using this indicator, to use the numbers over here, where we can see the absolute values of the indicator, because sometimes it can be really splitting some hairs. So for example, on this move down, I've drawn in a line here to approximate where 40 is, but where we can see its absolute value is to point at a given day and then look over there in this top left area at this number right here. It's the one that's always going to be between 0 and 1. And as I point at June 12th, you can see that that value got down to 0.3769. Yep, we are below 40. That is not the signal. The signal is if the oscillator starts to recover and go back up above 40. So let's advance our line just a little bit. Right there, you can see, looking back at the numbers tell the tale. We're at 0.425. We're back up above 40. And what that means now is those candles on this weighted basis are starting to close closer to their highs again. So there may be some subtle shifting in that momentum, and it might be signaling that the trade or that the stock is about to start moving higher again. So right there is a signal within this upward trend. Okay? Let's see if we get another example. Right here is a near miss, and this is where I believe it's a near miss. Yeah, look at this. So as I point at that little dip that we had there on July 25th, look at the ultimate oscillator value, 0.404. Now, for some traders who allow for some more flexibility in their approach, they may say, you know what, that's close enough, and they take the trade. However, they may also take objection to that because look at where we are relative to a trend line. So maybe the trader is not terribly thrilled with that, and they decide to hit the pause button. This is where using the indicator in isolation might lead us into, you know, trading blunders, basically. You never know whether it's a blunder. It didn't, in this case, it turned out to be. It's always what happens after the trade is taken that determines whether it's a successful or failed trade, right? But yeah, in this case, we didn't quite get below 40. This wouldn't normally be considered a valid entry. We rally up a little bit on the oscillator and then push down again, and we get down to 0.378. Do we get back up above 40 again? We do right there. Let's see. Let's position our cursor there. Yep, it's that white candle day right here, where we snuck below 40, pop back up above. That's our trader's signal that we may be starting a rally again in the direction of our trend. So then the question becomes, well, if that's the entry signal, and Kylie says, is it possible to create an alert for a signal to break through a signal line? Could be done, yeah, through ThinkScript. Now, I don't get into that in this webcast series, but we could create like a custom script. I do not believe, I'd have to check, but I don't think that's it's one of the technical functions on like our scan right now. All right. SJS says, can you bring in other indications of strength on the chart? Could the trader also be looking for a confirmation from candle behavior? Could they be looking at some other oscillator, for example? Yeah, this is where we could create layers of, boy, I'm tempted to say sophistication, but sometimes it might be layers of complication to an approach, right? There's a trader's typically trying to strike a fine balance. It's always tempting to layer on another technical indicator. Sometimes that can add value. Other times it can add layers of complexity that aren't actually adding to the performance of a trade plan, and all they're doing is causing a trader to miss signals. So we have to look for that balance. Obviously, only experience can determine whether it was a valuable or unnecessary addition. So yeah, experiment with it. Experiment with it. Okay, but in any case, if we're taking the entry, where might the plan be for taking profits if the trade works out? Where might the plan be for taking losses if the trade fails? Well, profits on an uptrend, the profit management technique is typically different when using this oscillator than when we have a sideways trend. And it's also typically different from when we have maybe a downtrend. And yes, some traders actually do use this to take bullish trades in downward trends, but using a different exit approach. So our exit approach with an uptrend, when might we take our profits? Well, in this case, we may use what's called a measured move. What's a measured move? Well, literally, I think it's a great title. We just measure a previous move. So for example, the last time we got a signal like this, how far did the stock travel before it made a significant reversal? So in this case, we might measure a move here from about $180 up to about $205, about a 25-point move. And so if we pulled back and it's generated another signal, and that signal started down here at 190, maybe we project up to, let's say, 215, about $25 up. That's called a measured move exit, quite commonly employed when trading the ultimate oscillator in an uptrend. Okay? Where might profits or losses be taken? In other words, where might the stop order be placed? Well, in this case, it doesn't really matter whether the trader is trading uptrend, sideways trend, or downtrend. They might just exit if a support level is broken. This oscillator typically generates its signals in uptrends, sideways trends, or downtrends down at or near support levels. A broken support level can signal that, all right, maybe this signal is not working out. So in this entry case, maybe the trader has a stop somewhere down here. In this entry case, maybe the trader has a stop somewhere down here, but down below whatever they consider to be the most recent support area. Okay. All right, so that's using this ultimate oscillator for uptrends. What about sideways trends? What about downtrends? I want to look at a chart that's actually given us a signal in all three of those time frames. Let's look at Salesforce. So this one we've already acquainted ourselves with. Here we have a period when Salesforce was in an upward trend, making higher highs and higher lows. Maybe for some traders, they define their trend by a moving average. Maybe they have a 50 or a 100 period moving average, something like that. But in any case, if we're moving up, the trader will look for the oscillator to dip down below 40. So you'll see here, there's our little carrot, our little alligator, is it the alligator mouth that we learned in grade school? Yeah, dipping down below 40. Now there's a reason why this changes with different trends. Okay, I'm going to draw this in here a little bit. Let's use my rectangle box here. With a persistent upward trend, it's quite common for this oscillator to spend most of its time between about 40 and about 80. Okay, it'll typically kind of float up here. So if we're waiting for signals down here at 35 or at 30, it can cause a trader to miss out on an entire uptrend. The signal just never comes. Now, when a stock starts moving down, the indicator will typically rapidly move down to between 60 and 20. 20 is actually fairly uncommon, but 20 or 60 to 20 or 60 to 25, something like that. On the other hand, when we move to a sideways channel, then we'll kind of float between, let's say, 30 and about 70. So we might be here. So we actually shift the way the oscillator is used, if that makes sense, based on the trend. We're still looking for extremes, but the definition of those extremes can be quite variable. So when we're in an upward trend, an extreme low might be defined as something below 40 on the oscillator. With a downtrend, the extremes shift lower, so getting down below 30 may be the signal. For example, here we are in our downtrend. We get a strong sell-off on our stock. Think about what might be going on in traders' minds if they're just following price. This looks brutal. However, those average values were closing down close to those lows on our candles, basically over 3 time frames. And then we start to get a reversal of that. This sort of an extreme for some might represent a pretty good entry opportunity. Does it always pan out? Of course it doesn't. I can't show you any indicators that are perfect in their identification of lows. But this is an oscillator that's sometimes used to trade counter trend, looking for bullish entries in bearish trends. However, they tend to be few and far between, and the exit tends to be relatively quick. So let's talk about the exits if we're taking a signal in a downtrend. So we see the entry getting down below 30. Where did we get to on this one? We actually got down to 0.246. And then we closed up on that day. Yep, it was this candle that I've drawn my oval around. That's the entry. Where's the exit? Well, the profit exit is commonly the downward sloping trend line. So you'll notice my note here. Exit, typically a downward trend line. So right about here in this case. Had the trade not panned out, where might we have taken our losses? Well, a trader would typically look back to the most recent support level that they might identify. And in this case, there really isn't anything other than a recent low right there. So maybe placing a stop, a few dollars, maybe a couple percentage points below that low would be a typical loss management exit. So note how the rules, and these are general rules. It's not a prescribed only way to do it, but the typical approach is going to vary based on that trend. Uptrend, below 40, exiting with the measured move, but stop below support. Downtrend, below 30 is the signal, exiting at the trend line with a stop below support. What about this sideways trend? Well, in this case, we're looking for a dip below 35 because our typical trading channel on the oscillator has shifted upward again, kind of centered itself. So a dip below 35 and then rising back up above 35. So let's look at the absolute numbers. Looks like we got all the way down to 0.286 in this case, but we rose up above 35 again on, what date is that? Get that number out of the way. That was actually on the 10th. Yeah, so that was this red candle right there. So that's our entry signal. Well, do we exit at a measured move? Well, we could. Do we exit at the downward trend line? There's not a downward trend line. Here we're just looking for horizontal resistance. When we have a sideways trend, typically it's quite typical to see highs being relatively similar. And we might target that as a profit management exit technique. Where do we place our loss? Our stop order below support. That's a typical exit. Okay? So 3 different trends, 3 different ways that we might plan our trades here. Let's pop over here and have a quick look. I'll put this back up where everybody can see it again. Might as well get that on our screen one last time. But if we go up here through our stocks in our S&P 500, and this is not the only way to do it, the only way to look for stocks, this is just sort of convenient for my presentation purposes, looking at the biggest companies on the U.S. exchanges. But how might the trader apply this approach? Well, we have uptrends on Apple. Let's see if we dipped below 40 here. Oh, matter of fact, this ties right back to something I wanted to discuss on our last chart. Looks like we didn't get a dip below 40 there. That would be a near miss. I did want to talk about this on our CRM chart. Let me come back to Apple. See that little question mark I have right there? And you can't quite see it, but let me hover over this oval so you can see I had an oval around this event right here on our ultimate oscillator. Look how low we got as I point at that day. We got to 0.358. A trader's rule, if they're going strictly in accordance with what I've outlined today, that did not get below 35. It got to 0.358. So the question there becomes, well, traders, if we're using this, are we going to allow ourselves to take entries on those sorts of signals where they're near misses on the oscillator, but we may have enough suspicion from the chart that maybe a close enough is close enough on the oscillator? I like to kind of throw these things into the discussion just to illustrate the fact again, once again, that there's lots of flexibility in how these oscillators might be traded. I'm outlining one example set of rules for how it might be done, but lots of different variations on that theme, or potentials for variation. Anyway, back to our watch list. I think it's useful for a trader who's first initially introduced to something that's new to go to a series of charts, try to identify a trend, and look for their signal to see if it's being productive or not. Which approach might we take during this time frame? Which approach might we take during this time frame? And what is the current time frame? What does this look like for Apple? I think a trader could look at this and say, well, it looks like our highs have gotten lower. This one's getting kind of similar. Lows have gotten higher. That, by some technical definitions, it's not higher highs and higher lows. That's not an uptrend. It's not lower highs and lower lows. It's not a downtrend. So pretty much everything else falls in the category of sideways trend typically. So Trade and Grow says, could you scan for current stocks under 30? I don't think so, but let's go learn together. Okay, but I did want to point out on at least one additional stock. First, we'd look for the trend. And in this case, lower highs, higher lows, kind of sideways. In that event, we'd need to see this dip down below 35, and it didn't get there. Hasn't gotten there recently. That's what we might be looking for at the moment. But can we run a scan? I don't think so. As a matter of fact, I couldn't demonstrate it even if we could, because right now I'm in my simulated trading account and what we call study filters. So if we went to our scan, we do have filters called study filters, but they're not available on our paperMoney. So if I click on that, it'll say study filters allow scans based on predefined custom studies. But let me go back here so we can see it one more time. You are not permissioned for study filters. Well, that sounds kind of harsh. All it means is it's in the paperMoney account. It's not in the live account. In the live account, we could go at least take a look. I don't think the Ultimate Oscillator is one of those studies that allows filters. I might be wrong, but I don't think so. Okay. All right. Well, you know what? Actually, we've accomplished what I set out to do today. So let's do a little quick recap on what we wanted to discuss in today's advanced charting techniques. Today we wanted to talk through this thing called the Ultimate Oscillator. What is it? And so many of you, it looked like all of you said, nope, I know nothing about it, or maybe I've heard of it, but I still don't know what it is and how it works. So I wanted to talk about how it's built. I wanted to talk about how it might be used to generate trade signals, and then walk through some examples on Thinkorswim desktop, and we did exactly that. Okay, so everybody, thanks for giving me your time today. Don't go just yet. I do have a couple of other suggestions for you. Number one, if you're not following Connie and me on X, please do that. It is a great resource, very best place to connect with your favorite presenters. Like you can even give me some comments on what you think is happening here with Meta. I posted this. What is going on with Meta? For those of you who missed a recent webcast where we talked about this, what is this pattern and what might it mean? Okay, it's not a recommendation that you buy Meta, but it's just an illustration of pattern analysis. But yeah, that's the best place to connect with Connie and me in between the live streams. And it doesn't cost anything to follow, so come and follow us on X. Also, make sure that you're subscribed to our Trader Talks channel. The YouTube channel is the very best place to find our previous webcasts organized in a really meaningful way. They're organized by playlists. So like if I go to these playlists and we start looking down through here, you'll see you can find broad topics for what you might have an interest in. So how about we just grab one as an example? Like since Connie's here, I filled in for Connie's webcast just yesterday. So let's give that a promotion. Yeah, right here. Connie's long options playlist can be found right there. If you're just learning about long options, you can see my webcast from yesterday. Here's everything I can teach you in 41 minutes about trading long call options. Or Connie, the previous webcast, using multiple chart timeframes for assessing patterns and entries. Great things that can be learned here. But yeah, make sure that you're subscribed to our Trader Talks YouTube channel. You can go down and click on the subscribe button right now, and doesn't cost you anything, literally takes a second, and then you'll have rapid access to all this great resource. You can join our live streams here as well. All right, everybody, it's Friday. We have a few more webcasts coming up for the rest of the day, but you've all earned your weekend. Go enjoy the remaining webcasts. Also, I want to wish you a happy weekend, but thank you to everybody that's already clicked on the like button. I can see 34 of you have already clicked that like button out there. I hope you're in that habit. Every time you watch a webcast and you enjoyed it, make sure you don't leave out clicking that like button first. That literally takes a second. It's a final parting farewell thank you to your presenter, and it helps that presenter's webcast get a boost in the YouTube algorithm. Okay? All right. Yep. Go enjoy your weekend. I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.